Good evening, everyone. How's everyone else doing today? Glad to have you here tonight on this lovely Tuesday evening class. Thank you so much for joining us as we are here to learn about side hustles, gigs, or maybe you are just self-employed and you want to learn about what it takes to qualify for a mortgage because every day most of us nowadays have like a side job. Maybe we do a job on the side where we get paid cash, and we don't know how that is going to affect us when applying for a mortgage. So today we are here with Daniel Garcia from Iberia Bank, where he's going to talk to us about how you putting that information or your income in your taxes is going to affect you of what you're able to afford. So please pay close attention to all the information that he's going to give you today. And then ask your own questions. That's why we do this webinars so that you can always ask the questions that you have. Okay, even if you're not self-employed right now, make sure that you pay attention because maybe in the future you will become self-employed, and how is that going to affect you in the future as well? If you try to purchase a second house or do anything with your credit. So thank you so much for joining us, Daniel. How are you?
Hey, I'm good. Thanks for having me. I'm just super excited about this presentation, simply because I think it's very, very much needed. Just get a lot of questions about this kind of stuff, so here we are, ready to answer them.
All right, thank you, Danny. We just please let us know a little bit more about you and then the bank you work for.
Yes, absolutely. So my name is Daniel Garcia. I'm with First Horizon Bank, Iberia Bank, First Horizon. We're actually merging, so we're kind of going by two names right now. But yeah, I've been volunteering with Habitat for Humanity for few years now. Love helping with these presentations and these classes. My job with the bank, or my specific role, is to help lead their efforts in making sure that we give back to the community through our affordable community lending products, through our grant products that we have available as well. So, and then of course, things like this, offering our expertise in this field in educating homeowners or potential homeowners as well. So glad to be here.
Awesome. Let's get started.
Will do. So give me one second here and I'll pull this up and we'll go ahead and get going. So tonight's presentation is basically about self-employment, side hustles, gig work, and self-employment, qualifying for a mortgage with this type of income. So just a quick reminder that, as a bank, as a lender, that's what we are. We're mortgage professionals, we're mortgage experts. So just keep that in mind when we're going through this presentation, that always talk to a tax professional about this information to confirm it, tax professional, CPA, because everybody's situation is different. The information that we're providing you tonight is just based off of our experience that we've had throughout the years in helping families become homeowners, and just the effects of how we look at it as a bank or as a mortgage company, as a lender, on how your taxes affect your ability to qualify for a mortgage. So just remember, this is just information only. We're mortgage professionals. If you have specific questions about your specific situation, always consult a tax professional or CPA on that. So when we're talking about self-employment, again, what I will say is that I'm really, really glad that we're actually doing this presentation, because there's just so many things that are involved with qualifying for a mortgage. And when it comes to self-employment, there's a lot of factors that come into play when we're analyzing your ability to be able to get qualified. So a lot of the things that people don't understand is, just because you don't own your own business doesn't necessarily mean you're not self-employed. If you receive income from, having a side hustle, participating in what we call the gig economy, You might maybe doing some consulting work, contract work. A lot of times you're considered self-employed if you're taking in income and you want to use that income to be able to purchase a home. So think about that. So a lot of times we think of being self-employed, we're in business for ourselves specifically, we have a business structure set up and things like that, but that's not necessarily what's considered a self-employed person as well. Again, with these side hustles, these gigs and things like that, all of those are play a factor when it comes to gig work or when it comes to being considered self-employed. So when we talk about the gig economy, it's something that we're all familiar with. It's basically, if you're driving for like Uber or Lyft, things like that, a lot of people participate in these type of employment opportunities to make extra money. And, a lot of people do it for, great reasons. You want increased flexibility with your income. You have the freedom to set your own schedule. You can have make extra money by doing this. But the drawback to a lot of this is that your income does fluctuate. And when a lender looks at this type of income, if there's big fluctuations, that could be kind of tricky for us when we're offering some type, when we're looking at getting you qualified. And of course, in this type of business as well, these types of businesses, there's no medical employee benefits, 401k, health insurance, things like that. They may offer it for you to purchase it, but you're considered, a contractor, but a lot of people are involved with it, and that's what we consider the gig economy. So when we think about, side hustles or gig work or, things like that, examples would be if you're an independent contractor or some type of consultant, freelancer doing, photography, writing, graphic design, web design, doing some type of seasonal work or temporary work, driving for the ride shares, delivery services like for Amazon, DoorDash, Instacart, even cosmetic. We have some people who do hair, lashes, nails, things, all of these things on the side, and they get paid for it. So that's what potentially qualifies as a gig or a side hustle. So when you're accounting for this type of income, there's several things that a lender looks at when we're looking at this type of income. So first and foremost, if you're wanting to use this type of income to qualify, the first thing I ask somebody when they tell me, hey, I do this type of work and, can I use this to, to qualify? Well, first question, how long have you been doing this? Typically, you have to have 2 years of generating income from this source. And the majority of lenders, when we're considering income, any type of income, we always look at 2-year history of it. So it's whatever income you've generated within the last 2 years that shows a consistency. So if you've been doing it for 2 years and you're generating income from it for 2 years, you could potentially use it to qualify. The next question I ask is, okay, if you've been doing it for 2 years, do you report this income on your taxes? So is it declared as a business income, or is it a business loss? Is it a profit? Did you make a profit from it? So those are the things that we look at and that we take into consideration, because if you have a profit, then that's a good thing. Business loss, there may be something we need to, take care of or kind of work around. So when calculating your income with this type of income, with this type of income, what we're going to do is average it out for the last 2 years. So we look at the total income of your total taxable income, and that's what we call adjusted gross income. So when you're a business owner and you're self-employed, these examples would include when you own your type of business or a sole proprietor of a business. This is what we're talking about, not working in the gig economy, but you're an actual, by definition, a business owner. Sole proprietor, you're franchisee, you work for yourself, you pay yourself. So that's your primary source of income. Typically as well, what's considered in a lot of qualifying, when we're looking at getting you qualified, if you work for a company that you have ownership in, technically if you have more than 25% ownership in that type of business, you are considered self-employed. So that's what we look at when you're looking at your situation and really determining whether or not you're self-employed using this gig economy. So if you're for self-employed income, one of the things we're going to look at the accounting for it. So when you get paid cash, do you receive cash income or Form 1099 by your employer? How do you keep up with this type of income? Do you report this income on your taxes? You'll notice we're going to ask about this a lot when we're talking about self-employed income. Do you report it on your taxes? If so, is it a business income or is it a business loss? That's something we're going to evaluate. And then again, how long have you been doing it? We always look at 2 years. And is it leveled income? Is it increasing? Is it decreasing? Those are things that we're going to take into evaluation. So, again, as with the gig income, we're going to look at your adjusted gross income for the last 2 years, get an average income over that. And then we're going to want to look at your year-to-date profit and loss to determine whether or not your income is on track to what you made previously. So if there's a big reduction in income and you're only going to make half of what you made last year, that's something we would definitely evaluate, and we'd have to take into consideration whether or not, we could get you qualified for financing. So, when we're thinking about self-employment income, all of us who are self-employed, myself included, I work for the bank, but I have 2 other side businesses that we generate income on and we pay taxes on and stuff. So there's many things that we have to take into consideration. And in tax time, the IRS allows us to take advantage of these tax deductions and write-offs. But these things, what these deductions do is they reduce the income that you get taxed on. So remember though, we can only count income that you pay taxes on. So if the amount of income that you're taxed on, the adjusted gross income shown on your 1040, that's the tax return form, the 1040, and then the Schedule C profit and loss statement on your tax returns, these are what we look at when considering your loan approval. So even if you have primary employment, like in my case, I work a full-time job, but I have 2 other side businesses that we care for and that we operate. If I'm going to go apply for a mortgage, they're going to look at those businesses as well, because if I'm going to use those to qualify. Now, typically what happens too sometimes, and we'll talk about this shortly, if you have a business loss, they could ultimately even take that loss from your employment income as well. So it could potentially affect how you write or how you qualify for financing. So that's, when we're talking about these deductions and write-offs, and we'll reiterate this a little more throughout the presentation, we can only count income again, the type of income that you pay taxes on. So, I've seen this many times, and I'll talk about this more, is where, especially like hairstylists, and I use that as an example because my family, we own a hair salon as well. But we see our hairstylists that they'll say, okay, gross profits before all the deductions and stuff, they made, $60,000, $70,000. But then they took all the deductions and business losses and wrote down and only paid taxes on $24,000. So that means we can only use $24,000 to qualify you for a mortgage as your annual income. So, that's something to think about. Just so, what I always tell people and tell them is that, look, if you're going to buy a house, you're going to have to bite the bullet and pay your taxes. Is what it comes down to. Try not to take all these deductions, because that adjusted gross income is what your lender is going to look at. So taxable income and purchase power, we talked about this a little bit. Your adjusted gross income will affect how we calculate your income. But as a result, this can affect your affordability and reduce your qualification amount. So one of the things we look at when we're talking about this, when we're looking at self-employed income and how it relates to qualifying for your mortgage, is your debt to income ratio. So let's say you, take that example that we just talked about, $24,000 a year. So when we're looking at qualifying you for a mortgage, if you paid $24,000 on taxes of $24,000, that means you get about $2,000 a month. So debt to income ratios, which is basically a percentage. So your new house payment plus your monthly debt can't be more than a certain percentage of your gross monthly income. So if you have a gross monthly income of $2,000 and the debt to income ratio guideline is 45%, that means that you've only got $900 to work with to cover house payment and your debt. So hopefully you can kind of see and understand kind of where we're coming from when we're looking at this. So again, this taxable income definitely affects your purchase power because it ultimately affects your debt to income ratio, and it'll affect what you qualify for, the amount you qualify for. So that's really, really important. We're gonna go through a quick example here. So John, and this kind of explains exactly what I was talking about earlier. So John, he has a full-time job. He's a medical assistant. He's paid hourly by his employer, receives a W-2 each year. Additionally, John began driving for Uber Eats in his free time to generate extra income, some extra cash. He filed the income he makes from this job on his taxes as well. So in 2019, he earned $50,000 from his primary job. He also reported $10,000 in income from his side hustle. So you're thinking, okay, oh, cool, he's got $60,000 to play with to qualify. Well, when filing his taxes, John and his tax professional decided to deduct qualifying business expenses related to his side hustle, like vehicle depreciation, things like that. And then after filing all the qualifying expenses, he had a business loss totaling $15,000. So when it all said and done, he ended up having a $15,000 business loss. So gross income of $10,000 and qualifying expenses of $25,000, he's in the hole $15,000. So how does that affect his qualification? So this is actually a profit and loss statement here. And this is what we would actually look at when we're analyzing your self-employment income. So the 1040, and this shows up at the very, very bottom. We kind of show you kind of what it looks like here. So you see at the top there, number one, wages from the primary job. Then we have business loss. And then after that, you take that business loss out of the wages in the primary job, and you have left over $35,000. So here at the beginning, we thought, okay, he had $60,000, but then he took that loss. Now he's only got $35,000 left over to play with, or left over to qualify for a mortgage. So that's a big, big difference there. And that's what we talk about when you're filing your taxes. And when you take these business losses, it's going to affect how much you qualify for. So again, if you're going to buy a house, you got to bite the bullet. You've got to be able to purchase, pay those taxes. So questions, how do you think this adjusted gross income would be affected? How do you think John's adjusted gross income be affected by filing a business loss? So let's say he didn't have that loss at $15,000. We take that out of the equation. So you add that $10,000 actually back into his income. So he's got a total of $60,000. So now he's got $5,000 a month in gross monthly income that he could use to qualify for a mortgage versus the $35,000 a year. So why would a lender be concerned about the business loss John filed for his side hustle? Well, it's a loss. It shows that he didn't make any money from this, and by showing a business loss, what it tells us and what you've told the IRS is that you lost money by doing this job, and that's what you told the IRS. So that's what we have to do. how will John's purchase power for a mortgage possibly be affected by this side hustle work? Well, as we said earlier, it reduces his qualification income. So instead of using $60,000 to qualify him, then we're reducing it down to $35,000. So that's a big, big difference there. So takeaways from this, just because, you work full time and you have one of these side gigs doesn't necessarily mean you're not considered self-employed. Just remember that if you're going to be paying taxes on the side gig information or the side gig jobs, that if you take a loss, it could potentially affect your ability to qualify for a mortgage. So if you use this type of income, again, bite the bullet, pay the taxes. Pay the taxes. Always review your taxes carefully before signing, and beware of unlawful tactics used by tax preparers to reduce your tax liability. I've seen this a lot. A lot of times, because they don't want to pay so much in taxes, your tax preparer will give you, tell you to claim some business losses, even if you don't have a business, or even overstating some of the write-offs or deductions because you do have a business. So what I always encourage people to do is to talk to a tax professional that understands the purchase process. And I've worked with quite a few that know how this works, and they understand that a lender looks at the profits that you make from a business that helps you qualify. And that goes for self-employment. If you're fully self-employed and you have some type of business of your own and it's not a side gig business, understand again that these deductions, these write-offs, and these things like that, you can take them, but again, it could potentially affect your ability to qualify. So work with a tax professional that knows this process, that understands this buying process. So if you catch inaccurate information after filing, you can always amend your taxes. Now, sometimes we've had clients who took off a huge loss. They're self-employed and they took off all these deductions and they filed their taxes. Well, after talking to us and then after talking to their tax preparer, they did go back and, they were able to amend their taxes. Now, if they did that, they did have to pay those taxes owed, because then, they amended, counted more income, and paid more taxes on it. By doing all that, then we were able to get them qualified for more. And then just know that income isn't everything. That when qualifying for a mortgage, we look at more than just your income. Look at your credit score, your credit history, how much savings you have, basically credit, income, and assets. Those are the things we look at. And then when qualifying for a mortgage, those things are factored in. So that's pretty much all we have. Dallas Habitat has some amazing programs. Their counselors are some amazing people. If you have any doubts about this process or questions about this process, always talk to your homeownership counselor, because then they can provide you the resources that you need and the referrals that you need to be able to get those questions answered for you. When it comes to tax resources, there's the Volunteer Income Tax Assistance. There's some programs out of there that are available, and then PocketWise Cafe. This is just some other financial tools that you can use to be able to look up different financial tools, other tools that can help you be able to get yourself qualified for a mortgage or give you more information about certain situations, certain things like that. So what we'll do is open it up to a question and answer. Julio, or is there something you wanted to move forward with, or how did you want to do this?
Yeah, Daniel, I actually have a question for you. So someone had asked, what is the difference between doing the 1099, or people that when they file taxes, let's say they have their W-2 and they have they're a worker as well. Like, do you recommend anything in particular for the process for them, or what options that you think is best, or issues that you've seen in the process that you work with?
So if you have W-2 income, and you do side gig work. Is that
Correct.
what I'm understanding? Correct.
Yeah.
Okay. So most of the time, if the side gig work, if it's not a big portion of what your tax liability or what your income, where your income is coming from, usually we'll look just at your W-2 income. Now, if it's a major loss, I mean, we could potentially, reduce that from your income. So, my suggestion is you've got this side gig and you receive a 1099, pay the taxes on it, because you don't want to run into the situation, because I think it's going to vary by lender. Some lenders will take it into consideration and hit you with the loss if there is a loss. And then some lenders just don't even care about it. They'll just look at what your W-2 income is and move from there. But some of the secondary market mortgage products like Fannie Mae, Freddie Mac, FHA, depending on the lender, they may take that loss into consideration if you have it. So my suggestion is if you've got this type of income, use some of that money, save up to be able to, and anticipate that you're going to pay taxes on it. Don't take a big loss on it.
Okay, great. And actually, that's the second question that someone had asked was, is there a preferred program like FHA or conventional that they should be shooting for when it comes to gig? Like, I'm assuming they're asking pretty much, are they friendlier for gig or self-employed? Like if you do one program over the other, or does it just depend on what they sign up for?
It's in my opinion, I think they kind of all look at it the same with this type of income, because if we see that loss on there, I've seen it many times where the underwriter, regardless of what type of program it's going to be, they hit them with the loss if they see the loss on the tax returns. So the thing is just, if there's other compensating factors in there, there's some things we might be able to take into consideration. For instance, high savings accounts, you've got, a lot of funds in your account, or you've got a really high credit score. Those are some things that we might be able to take into consideration. But when it comes to the income, regardless of what program it is, if they see that on there, there's a good chance that they're going to hit you with the loss.
Thank you. Thank you very much.
Anyone else have any questions? Please do ask. We are here to answer any questions related to this topic. And maybe if you have just a general question about qualifying for a mortgage, since we have Daniel, he's one of our preferred lenders, he might just be able to answer that question as well. So any questions that you all have, please do put it on the chat or send it through the Q&A, and we'll be glad to answer those questions. Now, Daniel, another question that I was thinking about, it's that a lot of times what I see in our program is that maybe one year, let's say for instance, 2019, a client had self-employment income and wrote off a lot of deductions, right, to where reduced their income. In 2020, they didn't write off so many deductions. How does that affect them qualifying for a mortgage?
So it's still going to be reduced because we still have to average out. So what we're going to take is, so let's say, you in 2019, it was, $5,000 loss, but in 2020, you made $60,000 and you pay taxes on $60,000. We're going to average it out. So what we're going to do is take that $60,000 minus the $5,000, so that leaves you $55,000 left over, and then we'll divide that by 24 to give us a monthly average. So we have to take the 2-year average of it. So, at this late in the game, what I would say if somebody's in a situation like that, it may be more advantageous just to wait for the new year to come, because we're like about 3 months away. File your taxes, pay income on that, so that we can take the loss completely out of the equation, and then we'll just have your 2020 and 2021 income to look at.
Right. You make a good point, because if they do have the option to also amend the 2019 taxes, right, to where they can show now a business gain, for example, but now they're going to have to pay taxes plus interest on that. So like you said, it's more advantageous for them to wait for the new year to file their taxes.
And then another thing too, if you did something like that where you amended it, we're going to want to see, where do you have the funds to pay the extra taxes at? Do you have those funds available? Did you get on a payment plan with it? If you're on a payment plan, then we have to hit that as a liability for you as in your debt to income ratio. So I always say, at this late in the game, just wait a few months because you'll be better off. So, I mean, if you think about it, you paid $60,000 in 2020 and on your taxes, and you got another $60,000 this year. That's $60,000 in income that we can calculate for you to qualify. So it just there's a lot of other things to take into consideration if you do the amended route. So,
that one I didn't know that they were added to your liability. Okay, good to know that. Anyone else have any questions for Daniel?
Someone did mention, on average, how long do they have to have a gig, like their gig paperwork, like I guess file taxes before it gets added in income? Is it within the first year, or do they have to have it for like 2 years, like for W-2 employees that have their current job?
Yeah.
What is a good time frame for them to say, oh, you can count that in the income or the AGI?
2 years. So we have
2
to
years
show
as well.
2 years of tax return history, because that's the only way that's kind of our industry standard to show stability. It's 2 years. That's why when if you've ever made a mortgage application, that's why we always ask for 2 year work history or 2 year address history. We look at, because that 2 years is just kind of what our industry standard has been set as stability. So if you received it for the 2 years, then it is considered stable income as long as it's a profit and not a loss.
Thank you so much.
Naeli, I see you have your hand up. If you have a question, if you don't mind, just type it in on the chat. That way we can answer it for you. Okay, no question. Okay, so let's see. Maybe she's typing in. Daniel, thank you so much for taking some time today to give this insight on how the income of a side hustle, self-employment, or a second job can affect the way that we qualify for a mortgage. Again, to everyone that attended today, this webinar is recorded, so which means it's going to be made available for us on our website by tomorrow. So in the case that you would like to share with.
So here's a question. Ms. Torres asked, what does it mean when a liability if you are on a payment plan with IRS?
So an IRS liability is basically, like you said, it's a payment plan. So what that means is it's a debt that you have. So that means we include it into your monthly debt. So when we're looking at a mortgage to qualify you, when we talk about credit, we do analyze your credit score, but on that credit report that we pull, we take your monthly debt off of that. So if you have a tax liability and you have a payment plan with them and we see that, we're going to add that tax liability payment into the monthly debt that you have. So overall, it will affect your debt to income ratio. So at that point, then it could potentially affect the amount you qualify for.
Awesome. Okay, thank you. And then to go back onto a question you had answered early before that, when they say 2 years, do you need two full time, or I'm assuming they just average out the income, and divide it by 2. But someone asked, is it for full 2 years, or you need to be in the full time, or can it be part, or you did a side gig for maybe the beginning of the year, part time or half the year?
It doesn't really. So if it's the side gig or some type of self-employment income, it doesn't really matter as long as we show a 2-year history of it and that you paid taxes on it for 2 years, whether you're working it full-time or part-time. Income from a full-time employer, W-2, straight W-2 and stuff, we typically want to look at a 2-year work history on that. And it just, there's different factors that come into play on, gaps of employment and, how long you've been at this particular job, how long you've been on previous job, were you in school before then? Now, if you're working specific W-2 part-time work, and I'm not sure if this is kind of alluding to what some of the questions you had, specifically part-time work, even if it is W-2, we do most lenders are going to want to see a 2-year history for part-time work. Now, if it's gig work and it's self-employed income, again, 2-year history. So just keep that in mind. It's that rule of 2, got to have 2 years.
For sure. And of course, you know, if it's part-time, they want to, you know, work the full 2 years because that way they have more income. And then if they just work half the year, and then it's the less of the 2.
Yeah.
Okay.
So like if you're working part-time, you know, and you've only been working part-time for the last 6 months with no history of working part-time with a full-time job, you know, we wouldn't be able to utilize that income.
Gotcha. Thank you.
Okay. Anyone else have any questions? Feel free to ask away. We have time.
Oh yeah, we have plenty of time.
No questions, I'm assuming. A couple of people were asking questions about the Habitat program. If you are interested in the Habitat program, that is something that we also look at. If you're self-employed, the Habitat lender also does the same thing that a traditional lender goes by. So they look at last 2 years of taxes, and then also, you know, your adjusted gross income. So after your deductions. So either way you go, if you decide to purchase with the Habitat program or you decided to purchase in the open market, it will be the same process where qualifying for mortgage using a self-employment income as well. Okay. Like I was saying earlier, we host these classes on various topics throughout the month. So we'll be back on October for another class. So please do join us. That way, you know, we can get familiar with all this information that we have. The next topic that we're going to be is going to be intro to homeownership. So if you are thinking about buying a house, or if you're in the process of buying a house and you still have some lingering questions, you know, join us on that webinar. We will have another partner there that is going to be able to answer any questions that you have. Okay. Other than that, I don't have anything else. Again, my name is Porfirio. We have Christian here. If you haven't met Christian, he is our new team member. He has joined our team. And then again, thank you, Daniel, for joining us today to give us this information.